Why is India buying more gold than ever? And at the exact same time, China is sitting on record trade surpluses? What if I told you this is not a coincidence? And it has very little to do with weddings or festivals? What's happening right now is a silent global shift in money, power, and commodities. And most investors are completely missing it. By the end of this video, you'll understand how China's macroeconomic policies are quietly driving global demand for gold. Why India is right in the middle of this shift, and most importantly, how you can position your portfolio before the next phase begins. Every major financial shift in history leaves clues. Not in headlines but in trade data, central bank behavior, and commodity flows. Right now, one country is exporting more than it imports. Another country is absorbing real assets. And global money is slowly moving away from paper promises. Let's start with China. China is not only selling goods to the world. It's exporting deflation and importing hard assets. And gold is right at the center of this strategy. China is running massive trade surpluses. This means it sells far more to the world than it buys. But here's the key question. What does China do with all those surplus dollars? China does not trust the long-term value of fiat currencies, especially the US dollar. So instead of recycling surplus money only into US bonds, China is increasingly doing three things. China's central bank has been quietly buying gold month after month. China is stockpiling industrial metals like copper, aluminum, rare earths essential for EV, renewables, and defense. China is reducing dollar dependency by trading in local currencies and building alternative payment systems. This is not speculation, this is macro policy. Gold plays a unique role. It's no one's liability. Gold can't be printed. And it protects against currency devaluation. When large economies don't trust paper money, they don't buy Bitcoin first. They buy gold first. And when central banks buy gold, they don't sell it quickly. This creates a structural, long-term demand, not a short-term price spike. Now let's talk about India. India is not just culturally inclined towards gold, it is strategically positioned. There are three reasons for this claim. Indian families use gold as a hedge against inflation and currency weakness. Indians now see gold as portfolio insurance, not just jewelry. When China accumulates gold, global prices rise. And Indian demand accelerates before prices move higher. India doesn't lead the price. India responds early. Emerging markets are waking up to a reality. They cannot print reserve currencies. So instead of trusting fiat systems, they are moving toward real assets. This includes gold, strategic metals, commodity-linked currencies. This is why commodity cycles today are longer and deeper than before. Now the most important part. What should you do as an individual investor? First, think in cycles, not news. This is not a one-year trade. This is a 5 to 10-year macro shift. Second, think gold as insurance, not speculation. Gold should not replace equities. It should stabilize your portfolio. Consider sovereign gold bonds, gold ETFs, physical gold. Third, exposure to commodity-linked businesses. Instead of buying commodities directly, look at metal producers, mining ancillaries, infrastructure plays tied to global capex. Fourth, avoid overconfidence in fiat assets. When money printing increases, real assets outperform paper claims. Your goal is not to predict prices. Your goal is to stay protected.